Welcome to Stifel's Investment Strategy Brief, a monthly recap of the macroeconomic and market environment.
Well, greetings and welcome to the Investment Strategy Brief podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. In this episode, I want to get into the idea of navigating crosswinds that might be created by headwinds and tailwinds we're seeing, and really the struggle between resilience in the market and the risks that are out there. So let's jump in. As we've talked about before, geopolitical risks are all around us. We've got U.S.-China competition in good force, but risk of things like cyber attacks or maybe structurally higher inflation. These days, we're really focused on military conflicts, so the potential for any kind of re-escalation of Iran and Israel, or the discussions around peace, success or failure when it comes to Russia, Ukraine. So all of that in keen focus, and we're mindful that in some ways those are headwinds that could be problematic for the economy and the markets. And so obviously that's against a backdrop where in DC we've seen significant shifts. I would say headwinds include, of course, tariff uncertainty, worries about the impact that tariffs might have on inflation and that in turn on Fed policy and interest rates. Obviously big shifts going on in DC when it comes to policy. And of course, a big spending bill that was passed that net was stimulative. So I'd say the stimulative nature of the spending bill has been interpreted positively, but the uncertainty around tariffs have been sort of a headwind. And yet, as we see clarity, so trade deals getting done and certain issues getting behind us, in some ways, that's a little bit of a relief tailwind that has tended to help. All that's added to basically a reasonably resilient economy. So the consumer has remained engaged. We just got a most recent retail sales print, I think up 0.5% round numbers month over month, but think of it as 3-month rolling average holding up. And generally retail sales, sort of the month over month numbers bouncing around between zero growth and a little bit positive growth, all against a backdrop of an environment where by measures of sort of surveys, consumer sentiment and consumer confidence have softened a little bit. It moves around, but it's softened a little bit. Now, people are very focused on the labor market, and we've talked about the unemployment rate, non-farm payrolls, job openings, quits, maybe jobless claims. And, the punchline is for many, many measures, when we look at the averages pre-pandemic, we look at the sort of the strong reopening and then current levels. I would say many of the labor market metrics are kind of in between those two things, meaning better than the environment pre-pandemic on average. And so, when we look at unemployment, when we look at quits, when we look at JOLTS job openings, when we look at jobless claims, all of that data points to a solid labor market. One that printed that was negative was non-farm payrolls. And the increase in that was lower than expected with some downward revisions in recent months. And so people, of course, locked in on that as a crack, but that's against an environment where the labor market has held up pretty well. That translates to, again, muted but positive economic growth with a consensus forecast at 1.5% GDP growth in the U.S., down from 2.1 as we started the year. So not quite as optimistic, but still positive. Now, a recent reading was the 0.9% July month-over-month PPI headline reading, which was outsized. That's a very unusually high number. And so immediately, the analysts all jumped in and are trying to understand the influence of tariffs on that reading. But the punchline is what had been a reasonably soft environment, for that at least one side, the PPI side of things have firmed up a lot, right? And so right away, the market's repriced. There was at one point recently the expectation of 3/4 point cuts from the Fed as reflected in the futures market. That's down to 2, back to kind of where we started a couple of weeks ago at least. And of course, we know that if the Fed doesn't act and interest rates remain elevated, the cost of debt's going up. And that's true for across the economy, but especially the U.S. government, where our deficits have caused our debt to really get much, much higher, and it continues to go high. In any event, as it relates to the market environment, we know rates are high. So for fixed income investors looking forward, there's great places to invest. We've seen a calming of the volatility in the bond market. So that's kind of good news. And then when we look at the stock market, more broadly, we've talked a little bit about the first year of a presidential term being positive, with the average return being in call it the 8% range for those first year terms. Just on average, those years tend to be a little bit better. The first Trump administration had a return for the year of almost 20%. And then this year has been a bit of a roller coaster. We had a big decline down 19% on the S&P 500 around the tariff announcement. And then sort of with the pause, and then with trade deals getting done, then the spending bill getting passed, and earnings and profits holding up, the markets climbed higher. As I've mentioned before, we hit our year-end target of 6,200 on June 30th. So we do have a revised soft target of 6,500. And honestly, as I record this, market's not that far from that. So the market's just kind of moved higher. We're at an almost 25% premium when it comes to the PE ratio compared to the PE ratio's 10-year average. So that is a significant sort of overvaluation on a cap-weighted basis. As we've talked before, if we equal weight that, take out the effect of bigger tech-oriented companies especially, we get to values that are kind of more normal, if you will. And so that's something that we lock in on, is to say, hey, it's good to be diversified. I will say this, though, when it comes to the big tech-oriented companies, they have higher PE ratios. The sector, for example, information technology, has a PE ratio of 42.6 based on trailing earnings, and yet a growth rate expected to be over 16%, and that compares to the long-term earnings growth expected of the S&P 500 more broadly of 9.5%. Again, this is just analyst forecasts to the call it the next 3 to 5 years, something like that. So we are able to look at what's called the PEG ratio, to note that essentially the S&P is at 2.9, that information technology sector is at 2.6, and so it's actually not the most overvalued sector at this point. So again, we don't anchor everything on that PEG ratio, but it does help us understand sort of the lofty valuations when it comes to this higher than normal growth. In any event, another sort of tailwind for the market recently has been something that was a headwind back in April, which was there's sort of negative sentiment baking in when it comes to earnings forecasts from analysts. In April, roughly 2/3 of the forecasts were revising the views down, and that's kind of reversed as we get into August. Some of that's the reversing back of what had been seen, but also, just generally a slightly more positive view going forward. Now, speaking of positive views, I always like to take a moment to talk about our long-term themes, because really one significant tailwind in the current environment is just the optimism around technology, and especially artificial intelligence. So, we've got these themes: productive competition, the new consumer, shifting demographics, securing strategic resources, and then the fourth industrial revolution around tech innovation. But really, artificial intelligence in some ways is affecting all of those different themes. And it gets us excited about different kinds of investments, like opportunities, like where is quantum computing going? What about bionics? What about things like vertical farming for better production? Maybe there will be a resurgence of nuclear or other, maybe even cleaner forms of energy that might be new innovations. There's a lot of focus on health and longevity. There's a lot of focus on space and sort of automation, robots, things like that. So there's just really, when it comes down to this technology, innovation, artificial intelligence, there's so much going on in terms of not only immediate investment opportunities, but long-term views on that. And so again, we just like to pause and sort of identify that as a significant tailwind. So just to wrap up and to reiterate, our outlook for the balance of the year is for a little bit more clarity on tariffs. We still think inflation can be contained, but this recent PPI print has everybody's attention. We think the labor market's reasonably solid. We expect the Fed to cut once or twice. We expect the economy to grow at, call it 1.5% or so, and then earnings to hold up. And all of those are sort of factors that can contribute to this soft target of 6,500, as we mentioned in the last episode. But I'll just reiterate some of these headwinds and issues: policy uncertainty, inflation reaccelerating, maybe the consumer demand, given worries about all that, softening, or an unexpected geopolitical conflict, all of that can add to sort of softening optimism, sort of that weakening of what we call animal spirits, and the potential for a move down in the market. So our sort of catchphrase has been modestly positive looking forward, with a little bit higher probability of some negative news potentially influencing the market in the near term. So we really appreciate you taking the time. I wanted to do this August episode, even though sometimes we take August off, just to provide a fresh update on the environment. So thanks so much for listening to this episode, and we'll catch you after the holiday, really ready for the sprint to the end of the year. Thanks so much.
Thanks for listening to Stifel's Investment Strategy Brief. Be sure to subscribe wherever you're listening to automatically receive each month's podcast in your feed.